The U.S. economy created 257,000 jobs in the month of January, according to that latest jobs report out on Friday. This number has many economists wondering when the next Federal Reserve interest rate increase will be. Joining me right now is Grant's Interest Rate Observer founder and editor, James Grant. And Jim, it is always nice to have you on the program.
Thank you, Maria.
Let me get your observation of where we are in the economy. Let's talk macro for a second, whether it be job creation, deflation, strong dollar. How would you characterize
things? Or the future. I heard you mention a snowstorm a moment ago, and in New York City, we almost had the blizzard of all time. It was about 2 weeks ago, remember?
They were calling it epic.
They were calling
the forecasters.
They were calling it unprecedented, iconic. And it was forecast as late as the Friday before the alleged onset on Tuesday, and it was unforecast as late as Monday before the supposed onset on Tuesday.
Right, which is why in your latest February 6th Interest Rate Observer, your headline is to outsmart a snowstorm.
Right, so the point being that snowstorms are physical phenomena. Meteorologists must have hundreds of thousands, if not millions, of observations of given weather patterns. You know, big data can be crunched and manipulated and supposedly forecast, right? But snowflakes, unlike investors, do not surf the web. They don't change their mind because of something they saw on television. They are inanimate. So if we can't exactly forecast the supposed greatest snowstorm of all time, at least not in New York City, how can we then presume to forecast the conduct, the behavior of hundreds of millions of people who do have their own ideas and who do change their minds and who do respond to their own interest and to stimuli from outside? So all this reminds me of the conceit and indeed of the futility of a great deal of what passes for macroeconomic theory and forecasting.
But when you look at what has occurred, can't you come up with some model as to be somewhat
Yes, markets are in business to confound the consensus. That is my working model for macro, micro, and investing.
So what do you see right now, given the job creation that we saw on Friday and the idea that people are worried that, in fact, deflation is a bigger risk than inflation?
Yes, well, I would have people, first of all, define terms and try to distinguish between deflation, meaning a derangement of debt in which over-levered actors are forced to sell assets, are forced to fire employees, are forced to divest everything to meet fixed charges. That is deflation. That is a genuine collapse in prices owing to problems with debt. But there's another kind of deflation which we civilians call progress, and that is the Walmart business model, every day lower and lower prices.
Right.
And as the world progresses, as productive techniques improve, one should expect that the cost of producing falls, the cost of purchase also ought to fall. Everyday low prices means progress. It means a dividend for consumers. The central banks of the world have set their faces against, in effect, progress. Now, when the Fed got into the business of manipulating the price level, so 1977 was the year that the Fed got its two remits, stable prices, so-called, and full employment. Bill Gates and Steve Jobs in that year were both 22 years old. The digital future had yet been unrecognized, but we have a world with internationally linked labor markets. We have these wonders of productivity, which sometimes don't show up in the data, but still they are present, I say. And in this mainly wonderful world, we ought to expect a constructive dwindling of prices, and we call it, most ungratefully, deflation.
So what does it mean for the Federal Reserve?
It means the Federal Reserve, unfortunately, does really not subscribe to Grant's Interest Rate Observer. So what the Federal Reserve is going to do is to set its face against the progress they call deflation, and they will work to levitate the average price level, insofar as they can even define it and calculate it, to about 2%. That is their goal. Larry Summers was in the FT this morning,
right,
urging the Fed not to tighten until it sees the, quote, whites of the eyes of inflation. But in the meantime, there is a terrific distortion owing to these low interest rates in all our capital markets. We can see it in every corner of the globe. We can see it certainly in Europe, where in one Danish bank, they pay you to take out a mortgage, where you pay the Swiss to lend them money. It's satire today and news tomorrow.
It's actually pretty extraordinary when you look at yields where they are in the U.S., the 10-year, and then you look at what's happening in Europe, where they're even lower there as the market is making these predictions. So I guess the question becomes, what do you do as an investor?
Yes, that is the great paramount question. I've got a couple of ideas, Maria. One with respect to yield. No doubt many watching this program would like something to live on besides food stamps and Social Security checks. What do you do for income if you're a saver? Well, there's a kind of fund called a business development company. Golub is one of our favorites. It makes loans to medium-sized businesses. It makes the kind of the business loans that the Fed is now discouraging mainstream banks from making. It yields about 7%, priced a little over book value. We'd like it better if it were at book. But it has done very well for itself, especially with respect to the quality of its underwriting. It went through the 2008 experience with a very clean underwriting record. Now, its stock price got crushed, but its credit record was almost impeccable.
Well, this is a big deal. Jim Grant giving us stock picks, so it's
No. We've been doing this in Grants for 32 years. It's not such a big...
I know that you do it in your newsletter, but talking to you, normally we don't talk about stock ideas.
Well,
so Golub, what's the symbol on Golub?
Idea.
What's the symbol on Golub?
That's only for the subscribers.
We can find it out, Jim. Pull off Golub, please. What else?
Okay, there is. I have a long and a short, both of which are illustrative of the world we live in, which is by and large a pretty good world, except with respect to debt. There's rather too much of it. Now in China, there's an insurance company called Ping An, P-I-N-G space A-N, $100 billion market cap, $600 billion balance sheet.
Does that trade in the U.S., Jim, or only in China?
Hong Kong.
Hong Kong.
Yes, it's a little bit exotic, but it is illustrative, and the single we're bearish on it, and the reason is that Ping An has within it Ping An Bank, which occupies like 56% of the parent's balance sheet, and Ping An Bank, most revealingly, has a line item on its balance sheet called overdue but not impaired.
Wow.
But that's not so uncommon among Chinese banks. But this particular line item on the Ping An Bank is growing by leaps and bounds. So that is a short idea. Now, it's a long idea. There is a new face in the crowd of India investor vehicles, and it's called the Fairfax Investment. I think it's FIH in Toronto. It's Prem Watts's vehicle for investing in India.
Okay.
To us, the appealing thing about this is that Prem Watts is, first of all, a superb investor. Fairfax Holdings, his insurance company, has compounded book value like 20-odd% over the course of 30 years almost. But what he has a very good record in India as well, and with this closed-end fund and with a permanent capital, he has the opportunity, and I think he will avail himself of it, to invest in rather illiquid private equity type long-term investment. So if you
in India,
yes,
wow, interesting.
If you are a long-term and wish to buy into the prospect of a transformational regime under Mr. Modi, which I think is a pretty good bet, then this is, I think, is a very handy and appealing vehicle to do it.
Do you like international or better than the U.S., or you just zeroing in on India and this
name by name? I don't have any cosmic ideas on this, but we try to look from the bottom up.
Jim, it's great to have you on the show.
Thank you, Maria.
Thank you so much. Jim Grant is Grant's Interest Rate Observer founder and editor, James Grant. Take a